Welcome back to Real Vision. I'm Ash Bennington. I'm joined today by Mish Schneider, Chief Strategist at marketgauge.com. Mish, it's always a pleasure when you join us on the show.
Thank you so much. I really have to say, and I've said this before, but I can't say it enough. Real Vision has been such an incredible supporter to me, Raul, you, the crew behind the scenes. So I thank you so much for having me on repeatedly.
Well, you've been such a big part of Real Vision, so it's great to have you back on the show.
That's true. I started with you guys in 2018 in the Brick Studio in New York.
Oh, yes. Oh, yes. The Brick Studio down in Chelsea. How we miss it. A casualty of the pandemic. Mish, so much to talk about. We were chatting a little bit before we got on camera about everything that's happening in the background. Sometimes it feels like the background becomes the foreground. Let's talk a little bit about what's happening in Washington, D.C., how it influences markets. Big, beautiful bill, new round of tariff threats. Talk a little bit about how you contextualize all this background information that becomes the foreground when you're looking at U.S. markets and abroad.
Well, I'm famous for saying price dictates the narrative, and I think we cannot forget about that because that certainly has been the case. We can see that with the market in certain pockets near all-time highs and certain stocks like NVIDIA that got to 4 trillion yesterday. It's hard to argue that growth in AI and all of the future robotics and rocketry, space, nuclear energy potentially in the future, all of this is going to continue to go on. And it doesn't matter really what any administration does. But the problem with the administration and the BBB is that it's hard to discern right now what direction we're going to go from a macroeconomic point. Are we going into a stagflation? And we can certainly have evidence for that. Or are we going into disinflation, which would be almost the soft landing narrative? And we certainly have evidence for that. So where the price will dictate the narrative, I don't think we really have the ultimate say in that yet. So my job has been to be like Sherlock Holmes, to really put on that magnifying glass and look for the signs. And that's what we're going to talk about. How do you find the signs of which way we're going to go and what the impact is going to be of all of this effort to bring things back home?
Boy, that's the multi-trillion-dollar question right now. So how do you prepare for it? Do you have to sort of simultaneously think about these different scenarios, a soft landing scenario, an inflationary scenario, a recessionary scenario, a kind of Goldilocks scenario? Like how do you put that scenario management around everything else you're thinking about?
Well, I have a couple of ways to do it. Number one, of course, is my economic modern family. And without going into detail about what that is, really what it does is it looks at sector rotation. And considering 3 members of the economic modern family are what Stanley Druckenmiller calls the inside sectors that really measure the U.S. economy, you want to watch that first. So that would be retail, obviously 70% of the GDP. You want to look at transportation, how robustly goods are moving. And you also want to look at the small caps because that's the companies that are actually in the U.S. But also in the family is semiconductors, right? So that has been what I like to call right now the Wonder Woman of the entire modern family. But then you have to say, at what point does she, I like to put pronouns on them, not just she and he, by the way. Well, we're not going to go fancy on pronouns. What is she telling us, and at what point does semiconductors turn around and see that the family's following? Okay, all good. The family's not following. Wait a minute. And so this is where I look at these ratios that get stretched, growth versus value. A lot of people came into this year thinking value was going to be the thing, and we're still waiting for that to happen. So that's number one. Look at the family. It tells you a lot. IBB is in the family, and after a threat of 200% tariffs on pharmaceuticals, IBB actually broke out of a range it's been in as of yesterday. Number two is I look at the inflation indicator, so what I call the trifecta of inflation. So that would be the gold to silver ratio. You want to see, well, in this case, gold has been doing well and outperforming silver, but we've seen that ratio flip. If that continues to flip, you want silver to do well from an economic standpoint because you cannot have AI data centers without energy. You can't have economic growth without energy. But at the same time, you don't want to see it flip so much that it becomes inflationary. You got to watch the dollar. That's number two in my trifecta. The dollar has been under pressure, but it may have found a little bit of support I would say the rallies probably should be sold into, but the overall picture of the dollar is important because you don't want it to collapse. That means consumers are going to be impacted by purchasing power. And then third,
let me ask you this. When you're talking about the dollar, are you looking at DXY? Is that your index? Is that your benchmark?
That's what well, yeah. And yesterday I was looking at the dollar versus the euro. And you could see that the dollar euro ratio pairing right now is kind of like scraping at a bottom a little bit here, looking like from the momentum standpoint, it might go into a mean reversion, which would mean you probably want to prepare maybe for the dollar. Maybe it gets back up to 99, 100. I don't even know if it can get that far. That would probably be good to a degree in terms of the disinflation narrative, right? But if it breaks down further, which it could, that went back more in the inflation narrative or stagflation. We'll talk about that. And then
it's really been such a big move, 52-week high, 110.18.
Yeah.
97.78 right now on my screen.
97.78. Yeah.
Move.
Big move, and a move that we all sort of talked about, I think, last time I was on, in bearish dollar. A lot of people were still dollar bulls. But when you don't get the dollar moving after something like a Middle East crisis, then you know that the dollar is under pressure. And we can talk about why, but I don't even think it's all that important. European countries not buying our dollar, Asia not buying our dollar. We don't know about all of that yet. And I think that story, it hasn't really fully played out. We'll get back to BBB and Trump in a moment. And then the third part, of course, is I like to watch sugar because it really basically is even more important than wheat and soybeans and corn in that it measures stress of society. When sugar prices go up, you know that prices are going up, food is going up, people are reaching to sugar for comfort food, and that's an inflationary indicator. So if you look at that trifecta right now, we're not really seeing any signs of great hyperinflation. That doesn't mean it won't happen, right? Copper, of course, is a whole new thing, and we'll talk about the tariffs. And so I look at those things, and then I look at the bonds. Right now, I think you need to look at the long bonds. There's been so much talk about putting pressure on Powell to lower rates. There's rumors that Powell's going to resign. And essentially, if you look at a chart of TLT right now...
Has anybody told Mr. Powell about those rumors? Does Chair Powell know that those rumors are happening? I mean,
you got to give it to the man. He's got nerves of steel. He is composed. But yesterday, the FOMC minutes came out, and you could see the division where some members thought, oh, we should cut rates, and others didn't. And of course, the cynical side of that is which one of those said we should cut rates because they want to possibly be the new Fed chairman that Trump picks. We don't know. I mean, there's definitely politics right now involved in all of that.
No.
Yeah, right. But the point of that is if rates drop, even if the Fed doesn't lower and the rates drop, again, we still don't know what the impact. It's going to be good for the retail space. It's going to be good for the housing industry, but it also could goose inflation. So that's why I think anybody who comes out and says it's definitely going to be this or it's definitely going to be that, I'm not sure that would necessarily be a conviction to have right now. I think more it would be flexible, watch the signs, and watch those inside sectors because they're going to tell you whether or not Trump is going to wind up being the most successful president we've had ever in bringing things back to the U.S., keeping inflation under control, and putting money in the pockets of people who need it. We don't know that yet.
Well, this sounds like a very sensible view for the moment that we're in right now, which is stay aware, stay flexible, stay market and data dependent. But let me ask you this. When you talk about those inside sectors, maybe you could give us some scenarios for what that might look like. You just framed it out there, whether or not the administration is going to be successful. What might that look like? What might be some of the early signs, the early gauges that you'd be looking for? And what might be some of the risks rising? How would that look on your dashboard?
Well, right now, I'm mostly focused on the consumer. That's been my focus all year. And then when we had that big crash in April after the tariff scare, retail came back pretty well. Growth obviously led because that's what has been leading for the last decade on every rally. And you need the growth area to continue to lead. But like I said before, it only leads to a point in that it looks over its shoulder to see if the consumer is following, if goods are moving, and small caps are doing okay. Obviously, labor, that's a whole other thing because that's nuanced too, because we don't know how much of automation is going to be a good thing or a bad thing in terms of production. But anyway, let's not digress. Looking at the retail sector, as of yesterday, it was about 28% from its all-time high. And you know when that all-time high was made, Ash?
I'm going to let you tell me.
2021.
Hmm.
4 years ago. Why? Because of stimulus money. People were spending money, mostly e-commerce, of course, because things were closed. But people were spending money because people were getting money into their pockets. Since then, we've seen the consumer stretch from higher costs, even though we're seeing CPI, PPI, PCE not necessarily reflect that. You know, if you're a normal person who goes to a store, you're still seeing higher prices. There was stretch from higher interest rates. And so between inflation and now the fear of tariffs and higher interest rates, the consumer is now starting to get optimistic. That's the thing we really want to see. Right now, XRT is up today, up good, where NASDAQ is down. So that's the kind of balancing act we need to see for the best case scenario. Is the consumer participate even more than the small caps? If the consumer participates, then transportation is going to participate because, the consumer is going to have more money, more confidence. We've seen consumer confidence be really kind of crappy lately. If that shifts, then I would say this market will continue to scream higher and there'll be a whole new area of opportunity in the retail space. If XRT cannot hold this rally, if this is just some kind of a, premature excitement, which I doubt because it had an opportunity to go down really and it didn't. But if it does turn around and breaks down, let's say back under like 78 to 80, then I don't care what's going on with growth. I would start to think we're due for another correction for whatever the reason why is. And that's about as simple as I can make it.
Well, it makes a lot of sense. The focus on the consumer, 70% of U.S. GDP, as you pointed out. By the way, I'm looking right now at the chart you just mentioned, the S&P Spider retail ETF. This is XRT that you're talking about. It's been on a pretty good run since about call it April.
Exactly. It bottomed and then it had this massive reversal. That's when we really started buying a lot of things at that point. But we've been careful.
There it is. It's exactly what you're talking about coming up on the screen. Right now. There it is.
Yeah. So, I've always felt you have to be careful about what you buy. And that's, if like, again, let's go back to the roseate scenario. If the tariffs bring revenue into the country, if people start playing ball in other countries in terms of reducing the tariffs, like look at Vietnam. Now, Vietnam on Real Vision has been something I've been talking about for like 3 years now as a potential growth. Well, Vietnam just went over 15. Why? Because they made a deal with the U.S. And that is where the optimism comes from. And again, this is not to get political, but I'm just saying if Vietnam made a deal and they can see now that the economy is going to do better because U.S. is going to deal with them. And by the way, it's a nice way to skirt around China as well. What's to prevent other countries from making deals? This copper thing, of course, with this 50% tariff seems a little bit crazy. But we don't know you never know with Trump. Is this a negotiating tactic? All I know is that's the scary thing, because if copper rises that fast, then everything is going to cost a lot more. And that, of course, will affect the consumer as well. So when I say it's nuanced, it is. That's why, to simplify it, watch the XRT chart. That's all you have to do. If that continues to move up, it has a lot of room to the all-time highs. It doesn't even have to get there. It just has to stay in a bullish mode to give confidence to the overall market and the retail investors that have had this confidence since the April lows.
Well, it sure is confusing and complicated, and the game theory around the tariffs is one of the most interesting things. So, I mean, basically, you have essentially the two camps about the views of what the administration's goal here is. On the first hand, this view is that this is something that the administration is doing as part of the game theory of negotiation. You come off really with a very strong negotiating position and say it's really important for the United States to raise tariffs because we need to protect our industries. And that's the second position, which is this idea that the United States wants to raise tariffs because they want to generate revenue from those tariffs to protect U.S. industry. Now, what's really interesting about it is the only thing I'm certain of is that if your goal is the former, it makes a lot of sense to present the view that your goal is the latter. So, I mean, it's just really difficult to know which way this shakes out when you have this is a very complicated game theory going on behind.
Well, let's look at copper, for example. I mean, if the goal is for us to have copper mines here, how long is that going to take? I mean, we import copper. It could take decades, 1 or 2 decades, to be able to produce copper in this country. You have to think that the administration is aware of the reality of it and is using this as a way to punish countries that we import copper from, to get them to reduce it and for us to be able to, like you just said, the latter scenario. That's what you have to hope for. Otherwise, you have to think, has the administration gotten a little bit too optimistic about how much Trump's influence is in other countries and scaring them into doing business or not doing business with the United States? And by the way, that's where BRICS comes in, right? So there's been a lot of threats with BRICS. That's what I'm saying, it is so complicated, so complicated. That's why I keep going back to the simple. The simple is, if the small caps and the retail and the transportation, well, if they lead, that's even better. But even if they stay in the game and they hold firm, growth will do what growth will do. If it gets too stretched, which always happens, it has a nice dip. That's where your buy opportunities are. It's really hard to chase growth stocks. It's great to buy them on dips. But in terms of things that have been undervalued for so long, particularly in those areas of U.S. made, I think that's really where the opportunity lies if this thing winds up being successful. And again, the dollar is an X factor, rates are an X factor, and the other X factor, of course, would be oil, which is in a range right now. So it's hard to say what's going to happen with oil. It doesn't look like $40 a barrel is on the table. At this point, though, it's not getting through $68, and I'm talking about WTI. That would be my breakout area. And then we can have a different conversation, because the whole energy space, which we need it all, is going to get even more expensive.
Yeah, all of the above. Mish, let me ask you this. Since you mentioned levels, are there any specific levels that you're looking at, either to the upside or the downside, to see if this thesis is playing out, that seem to you to have particular resonance for whatever reason?
Well, let's talk about IWM. So the high in IWM was what, 244? And it's trading today, what, about 224? Since I'm talking to you, I haven't really looked at it.
But this, by the way, this Russell 2000 we're talking about, for the iShares.
Russell 2000. Yeah. So if you look at the Russell 2000 right now, that's still far from the all-time highs, but it did have a major breakout over 210 and 215. So if we had to look at levels right now, we can get through 225 convincingly. I would say it may take time and there may be gyrations in between, but it looks to me, like I said, I think the picture would be very, very positive in terms of saying that whatever is going on between the tariffs and the big, beautiful bill with tax cuts and deregulation is helping. In retail, of course, I mentioned that level of 80. That's super important right now. And right now we're clearing a 6-month calendar range high. So that's another positive thing. We still have a long way to go to the highs, but I would call 80 the pivotal area now for XRT to measure if consumers are staying in the game. And if we start to get through 80, I'm looking at a chart right now, 84, 85, that was the high in November, December of 2024. Good sign. And with transportation, even though Uber's been like the heaviest weighted component in the transportation sector, and it looks totally different than, say, if you look at the railroads, which have been really basing, you want to see IYT also continue to rock and roll and also try to get back to its all-time highs. IWM and IYT are closer to the all-time highs than the consumer is. That's why I'm focused on the consumer. That would be my best levels of advice. 70 in IYT right now would be your major support.
Yeah, IYT, this is the iShares Transportation ETF.
Right. These are all the members of my family. I mean, KRE, regional banks, is a member. Big banks obviously have done a lot better, but it's important because that's really going to measure the consumer again. Are they going to their regional banks in the small rural towns, borrowing money to buy things, to spend things, to build, to do home improvements, to send their kids off to school, whatever it is. And then it's rounded off with IBB, which would be biotech, also important because that's going to give you a pulse on how much people are discounting the tariff threat. And finally, of course, good old cryptocurrency is the newest member of the family, and that is just having a party.
What 111,390 on Bitcoin right now?
110 was a big breakout area. So we're looking at 120, 125. Last time I was on this show talking to you, we talked about the fact that the altcoins looked more interesting. We talked about Chainlink at that time in particular. Now I've been focused still on Bitcoin, but Ethereum, and I'm still really focused on Chainlink as well. And Chainlink over 14 looks good. Ethereum broke out over 2550. I saw today it was trading close to 2,800. The most recent high, I think, was 2,880. I see no reason why that can't keep going up too. The mass adoption headlines just go every day deeper and deeper into proving that a lot of people still think this is a scam, but the stable coin and the ability to get people exposure to blockchain and Bitcoin outside of having a wallet keeps growing.
Yeah, I think stablecoins were a major story this year, and I really think that this could be the well, if you just think about it structurally, the idea that you can enter the market and start playing around with this technology with dollar-denominated assets, that seems like just a mental shift for individuals who maybe have not participated in the space before.
It's what Netscape did for the internet. It's the same thing. So Circle, that IPO, there's a reason why that stock has done so well. And it'll fluctuate like everything else. But essentially, just exactly what you said. If people have the ability to have like a credit card that uses blockchain, but and Bitcoin, and be able to buy things without actually owning Bitcoin, people are terrified still, especially older people, of Bitcoin. But that would be a way, just like the internet. People were like, "Oh, the internet's not going to go anywhere," and then Netscape came out, and that was a completely different thing. This is the same kind of thing, and so I'm very, very excited about the whole stablecoin, and of course the government being behind it is huge as well.
Yeah, U.S. dollar stablecoins just open up a whole world of potential financial services denominated in dollars, excuse me, rather than in digital assets, which obviously vary dramatically against the dollar, highly volatile. But it is interesting to see that sort of that paradigm shift where people can participate in this in U.S. dollar denominated assets. Really interesting.
Yeah, and also probably means at some point banks will be obsolete as well because everybody can do whatever they need in terms of transaction peer-to-peer. See, the peer-to-peer thing is huge. I mean, that's what the internet really did. It created a space of peer-to-peer. You can send an email, you could have a website. People could buy directly from you. There was no middleman. And that's exactly what the stable coin situation is going to do, is going to be peer-to-peer, which of course means the banks may not necessarily need to be involved anymore.
Banks probably aren't going away tomorrow.
No, not tomorrow, but I'm trying to be forward thinking. Hopefully I'll be alive to see that. Because I've never been a big fan of banks.
Let me ask you this. Why Link? That's an interesting one. It's very interesting technology, the things that they're working on in the Oracle market. Why Link?
Well, because Link is the one area that takes things that are not on the blockchain and like a bridge gives the blockchain access to those things. And that's huge. That's huge because basically what it means is that the blockchain can access anything through this chain link, and that only improves the whole, like you say, through Oracle, the whole infrastructure of the blockchain. And Chainlink's the only company, as far as I know, that's doing that. So it's kind of like the whole story with Ripple, right? I mean, they keep coming out with headlines with Ripple. There was a big story there yesterday with Ripple. What was the story? New banking partnership with BNY Mellon to create as their custody bank to create a stable coin. It's the same kind of thing. You're seeing these, that's a peer-to-peer transaction. XRP, something Ripple that we don't have in the United States still, but globally as a way to do transaction without a middleman within a nanosecond. So Chainlink is kind of similar in that it's a secure way to access information outside of the blockchain, excuse me, through the blockchain.
And BNY, for those who don't know, is the largest custody bank in the world. They're the 800-pound gorilla in that space and have been moving in the digital direction. By the way, didn't they do a rebrand? Aren't they not just BNY? It's not BNY Mellon. It's just
I heard the headline yesterday. It was mentioned as BNY Mellon, so that's why I repeated the headline.
Journalists are always behind the curve. It's our lot in life. Mish, so much to talk about here. You touched on silver and gold. Talk a little bit about the precious metal space.
Well, if you look at the gold chart right now, and then I've been more interested in the gold to silver ratio at this point. I was all about gold. I mean, again, let's go back to 2018 when I started with Real Vision, and gold was trading at about $1,000. And on a subsequent show, I was asked, do you think gold is going to collapse from here? And I'm like, no, it's going to double from here. And now here we are at under 3,300, between 3,200 and 3,300. And people are like, gold's done. I don't think so. However, from a momentum standpoint, it certainly has slowed down. There's a little bit of a bearish divergence in momentum. Could it go to 3,100 from here or stop at 3,200? I think that's a buy opportunity, right? Silver, though, has interested me at that peak. When the April crash happened, the gold to silver ratio went to 115, right? So that means that gold was trading at 115 times more than silver. I knew that was unsustainable, and so it reversed. However, the 90 level, which used to be like the highest gold would be to silver, now is a support for gold to silver. If that breaks down, if it goes under 90, the gold to silver ratio, not only does that favor silver, but again, the implications are, A, silver is needed for energy, silver is in short supply, silver could be inflationary, and silver could go to 40, 50. So when people are asking me, is it too late for silver? It's holding above $35 an ounce. As I was looking at it this morning, it was trying to get back over $37. I think this whole consolidation here means that silver is going to explode to the upside, and that will probably put not pressure on the gold, but it will shift the ratio more in favor of silver.
Oh, let me jump back to something that you said in the opening earlier on, where you talked about the semiconductors, specifically NVIDIA being the first company to make it to $4 trillion in market cap. Obviously, a huge milestone there. Not the software companies, the hardware companies, the semiconductor companies. Talk a little bit about that and your view on NVIDIA.
Well, NVIDIA is NVIDIA. I mean, it's obviously not just from the 4 trillion standpoint, but it's a world unto itself. There's nobody doing what they're doing. And I keep reading stories that China, who wants to lead in the AI space, wants to buy NVIDIA chips. I mean, they can't compete. Nobody can really compete. There was that one story about DeepSeek, but it was short-lived, right? So I'm interested not so much in buying NVIDIA up here, but that's not my nature anyway. I'm not a big chaser on new highs. That's not what I do. I rather look beyond that. What do you need to make those chips, right? What is the hardware, as you just said, that's involved in this whole AI and chip making? And I've come up with a few interesting places to look. One would be Applied Materials, by the way, AMAT, but I don't have a position in that. What I did buy was a stock I've been following for years called Chemours, chemical. And Chemours, CC is the symbol, has shot up, and it's trading even higher again today. I bought it at the freaking lows, Ash. I'm actually pretty proud of myself on that one. I bought it at 7, and I think it's trading at 14. So it's a double at this point. And essentially what they do is they create the poly, and I'm not going to remember the full scientific word, but it's a coating, like a Teflon coating, which is Teflon's one of their products, that goes onto the chips to make the chips functional. You know, it's like buying companies that make hangers, because everybody needs hangers, and who needs chips all over for no matter what industry it is I'm looking at. So like I said, Applied Materials, Chemours is another one. And I'm also starting to look at, so what else could get more advanced in terms of investor interest as a result of the cost of creating AI getting more and more expensive? because of the energy costs for the data center. Well, one is to buy energy itself, right? Uranium, the copper we can see now, silver, lithium. I've also been looking a lot at solar. Today we saw Enphase. Remember Enphase? It was like all over it was the biggest buzz solar stock for a while. And TAN made this massive move last week, the ETF. And now Enphase, SolarEdge, even for solar, Canadian Solar, in spite of BBB and taking away the incentives, are rallying like crazy. Why? Because, again, let's go back to NVIDIA. So you have put NVIDIA at the apex, and then you make a pyramid of all the things that are involved in getting NVIDIA to continue to be NVIDIA and get usage and get bought by people who need. That's what I'm interested in. So it's solar, it's, companies like Chemours, companies like Applied Materials. MMM is doing well today. That's another chemical company to keep eyes on. These are the things I'm looking at. And the last thing I'm going to say about that is I'm also looking beyond that into, well, what else has been really floundering, but might be a cheaper way to make some of these costs of goods outside of the energy space because the raw materials have gotten so expensive. Guess what I'm back to? 3D printing space, not 3D printing, DDD, which is how I got famous on Real Vision in 2018. I called it for a double and it did. Now I wouldn't touch that stock because it looks like the only thing they 3D print is shit because the stock is like shit. But Stratasys, an American company, Israeli presence, right? Israel is working on the technology. They made a deal with NASCAR, which tells me, they can 3D print things for cars. They can 3D print for aerospace. Aerospace is another obviously dynamic future. Rocketry. That's where my mind is going right now. And if you look at Stratasys, it's trading at around 1150. It based out, and that thing is going up right now, sort of sitting there. But I think it's I think it's a good longer term investment.
I'm not a deep thinker about 3D printing, but this is just a fascinating technology to me because it's a technology that's absolutely incredible that just seems like it hasn't found a use case yet, right? The idea that I don't know, I'm gonna print plastic forks and knives for my picnic at home and I need a $3,000 machine to do it just makes absolutely no sense to me, never made any sense to me. But the idea of what you can do, the ability to fabricate through additive manufacturing anything in the universe to rapid prototype. I mean, there's so many uses for this, but it just seems like it hasn't found its niche yet.
Exactly. I think the key word there is yet. Yeah, from the consumer standpoint, it's ridiculous to have a 3D printer. It's just way too expensive. It takes too long. But from an industrial and obviously from a biotech, I mean, the things that they do with 3D printing now, they can actually 3D print a new scalp. So if somebody has a brain injury or a head injury, they can get a 3D printed scalp. That's how it's being used. So it's still very expensive. But I'm more interested not so much in the biotech space, which is awesome, by the way, makes ears and limbs for people. But I'm more interested in the capability of it getting more affordable so that it becomes less costly to build an airplane or an EV or even a gas guzzling car. Because now instead of paying for high prices for copper or steel or aluminum or silver, the cost becomes more effective and more efficient to 3D print.
Yeah. If for just about anything under the sun, any manufacturing industrial use, it's just an incredible technology that just hasn't found its space yet.
Yeah, but it will. And when you have a company like Stratasys trading at $11 or between $11 and $12, you have such a limited risk. I mean, it's one thing if we were talking about Stratasys when it was trading much higher. At one point, it was, trading much, much higher than this. It was expensive, but now it's cheap. It's a good value. That's at least my feeling on it. And by the way, my money's where my mouth is too. So that's always important to know.
Mish, I know I'm jumping around here a little bit, but you can talk about just anything in the world that touches on markets. And I want to come back to something that you mentioned in passing earlier, which was 10-year Treasury yields. I mean, this chart is really such an interesting one. And by the way, for people who don't follow it, let me just give you a little bit of the narrative. This chart has literally been until the lows on yield in 2020. This has been a story my entire life from 1987 down to 2020 when it bottomed out. This has been a chart that's just been down, down, down. And now since 2000, and it bottomed out around, I think one the low is around 1 point, well, I'm eyeballing it off the chart, 1.2, 1.3 on the 30-year Treasury yield, bottoming out, obviously, during that period of extraordinary monetary policy intervention. It's been straight up from 2020 to today, some hills and valleys along the way, but we're just shy of 5%. That's like 2007 levels, 4,888 right now on my screen. I guess a lucky number in some cultures. But boy, what a story on that. Tell us about the long-term price of capital, its impact on how you think about markets.
I don't think, a lot of people still think that the rates are going to go higher. I don't think so. And the reason why I don't think so, I think they've peaked. Now, do I think that we're going to see yields going back down to 1%, 2% like what Trump wants? I think that would be scary and dangerous. But nonetheless, if you just look at the chart, if you understand how to look, I guess, what I like to do is I like to look almost like a third eye into a chart. What is the chart really telling me here in terms of historical price action and current price action? And then on top of that, the momentum, which is something that as floor traders we used to count on, right? You could see the momentum increasing or decreasing when you're on the floor because the order flows would come in and it was obvious. The way we do it now is through this indicator that we have called real motion. And also its leadership, how it's doing versus the SPY for risk on, risk off. Right now, it's still underperforming the SPY. But if you look at the momentum, it started to clear and go higher in momentum in early June. And it did not cross the 50-day moving average. Then it finally did in mid-June, but the rally petered out. And when it started to sell off up until really basically yesterday when it had a nice pop, the momentum never went negative. It stayed good. So right now today, what we're doing is we're getting an inside day to yesterday's range above the 50-day moving average. And if you look at that 50-day moving average, which comes in around 86.60, and I like to look at the TLT versus trading the yields themselves, because this is the way, mainstream way to actually trade off the yields. If we get a close above that today, and then take out yesterday's high in price action, which I'll tell you exactly what it was. Yesterday's high was 86.93. So let's say we get through 87, either later today or tomorrow, being Friday, or even if we have to wait till Monday. You know what that's telling you? I don't care. The narrative will shift. And even if the Fed decides to cut or not cut, or Trump finally gets his way and, they at least kind of basically stay out of the way and they allow, it's going to help. Obviously, Trump wants the yields lower for good reasons, right? Not just to help the consumer, but also to pay off the debt. It's very expensive when yields are so high. What this is going to tell me is he's going to get his way. Whether it's tomorrow, in a month, 2 months, it doesn't matter. You're getting an opportunity to get in at a very low risk here as well. It's how I'm looking at everything. And yields are a big part of the picture. If they scream lower, inflationary. But if they just start to soften and people start to think that the yields have peaked for real and there's a possibility that they may go lower, you'll see TLTs climb really fast because everybody's short that space.
Well, and with good reason when you look at that chart for the last 5 years on the yield side. But let me ask you this, because you've just made a very detailed tactical case for your view on 5-year treasuries and on 30-year treasuries over that time horizon. But let me ask you this. How do you know that there's not a longer term trend in play? I mean, we're talking about these very, very long-term trends, 33 years down ticking just consistently, and then a 5-year rise. Is there any part of you that worries that this might be part of a bigger strategic, structural macro story, that there might be some risk of higher yields, or do you just think that the implications of that are such that they won't be allowed to stand?
I think the implications of such will be that they won't be allowed to stand. I do. And listen, the administration we know is trying to make changes to be able to pay down the debt, even though initially BBB is raising the debt. And I'm not an economist, so I'm not going to pretend to really know all the nuances of how they're doing that. But I can just tell you from a trader standpoint, And from a common sense standpoint, everything that he says, and the one thing that is really great as a trader is the transparency. Like talking the day after the April crash, stocks are still a good place to be. Buy them. I mean, he was right, right? He told you. He told you last week when he changed the deadline from July 9th to August 1st, don't worry, stocks are still going to go up. He's right. Now he's telling you the yields are going to drop. The interest rates are going to drop. So I kind of believe him. I see no reason not to. And I'll worry about the shift in that when I have to worry about it. But right now I'm saying from a technical standpoint, it's being proven. The momentum is shifted to positive. The price action looks like it's bottom. We've got now the 50-day moving average, which was very negative in slope, now starting to neutralize. And we've got an opportunity with a very low risk, let's say you're wrong under 85, to possibly see this go up to 90, maybe 90, maybe even higher than that, maybe 97, 98, maybe even back to 100. And then we'll worry about it then. That's how I look at things. I'm a trader. I'm looking for opportunity, low risk, good profitability, and I will take my profits when I get really good big moves and then use a trailing stop on the balance so I don't turn a winner into a loser. And if it continues to go higher, I have a piece of the action.
And that is why it is so much fun to have traders on this show. I love the conviction on that, Mish. Talking of which, we've got a question from one of our viewers, user.
Are we live?
As far as I know.
Oh, okay. Sure. Hi, everybody.
Hello, everyone. We've got a question from one of our viewers. User is the username. Any thoughts on the recent breakout in platinum? He wants to know.
Well, this is another key. Now, platinum, as far as I know, it shouldn't have been where it is, but obviously this is a domino effect. Oh, that's another big theme of mine, by the way. So I kind of referred to it a little bit when I said, look at semiconductors and then look at the domino effect of the things that all go into it and the companies that have to be involved and the energy needs, and then look at the domino effect of the energy needs. Oil may not be the supreme being in terms of energy needs, but look at the solar, et cetera. It's the same thing with this. When you look at gold rising and silver rising and copper rising, I mean, platinum actually moved up before copper. It's just the trend. Anything that's a metal right now, and that's a precious metal, is being bought up by speculators. We don't know necessarily what the supply demand is, or at least I don't know necessarily what the supply demand of platinum is. PLAT is an ETF that is not really great to trade because it has very little volume, very little liquidity, as opposed to SLV or even COPX. Those are the things that I will trade more because I'll go through the ETFs rather than the futures. But I have let me take a look at platinum. Actually, I have my charts up in front of me so I can give him a more educated response here.
So there are two. There's the physical platinum shares ETF, PPLT, and Granite Shares Platinum Trust, PLTM.
Okay. Let's go PPLT. That came up. Okay, that came up. All right.
There we go.
So you had this massive move. However, you've had a mean reversion in momentum, and it's starting to go back down in terms of its performance against the benchmark, which in our case is the SPY. So I would say that right now, kind of like gold, it's a little tired, and we want to really basically not do anything here in terms of buying. I would have a look, if it gets back down to around, and again, we're looking at that PPLT, I would look at it around 110. I'm not looking at the futures right now because this was the easiest thing to do. So between 106 and 110 has to hold at this point. Here, I think you have too much risk. If anything, I might even consider going short if it breaks down into yesterday's low if you're a more active trader.
Always impressed by your ability to do this on the fly.
Well, I look at about 1,000 charts a day, so you got to make a decision real fast. And so pass. Ooh, interesting. That's kind of how I do it. But then could we talk about the thin economy? Because I have to say, before we run out of time, to me, this is the most exciting thing happening in the economy in the U.S. and globally. And I think it's one of these areas that can do well regardless of what the economic macro condition is going to look like, unless we go into a deep depression. That's a whole other thing. But even in the depression, women went out and scraped their money together to buy nylons, right? So we know that there's the lipstick economy in bad times. But the thin economy or the vanity trade, I really want to talk about that. Can we talk about that for a sec?
Absolutely. Absolutely. I think
Okay.
I'm the only person I know who's not on GLP-1s right now. It's literally like 50% of my friends.
Exactly. And this is what I'm telling you. If you see somebody you haven't seen in a month and they're 20 pounds thinner, you know why, right? And, so quickly the backdrop is that for years, for decades, forever, people who wanted to lose weight would yo-yo diet, right? We've seen every diet fad under the sun, from sporadic fasting to keto, and then Weight Watchers, and before that, Scarsdale, and, all the rest. And I know because I have some dear friends who have tried every single diet under the sun. And then they go back and they not only gain all that weight back, but then they even gain more weight back, right? Because they're frustrated. So this opens up a world for people. 38%, somewhere between 30 and 40% of the people in the United States are either overweight to obese. That's huge. There are statistics coming out right now that means that this whole area of people who can take off weight and keep it off will enter the consumer scene, buying things that they've never bought before, doing things that they've never done before, and not doing things that they've always done before, like eating a lot of junk and drinking a lot of alcohol, could add 6% to the GDP. Think about that. That's huge, right? So I have been studying this. It's been premature. I'm always early, but I know the end of 2025 into 2026, as they get cheaper, as the competition for the drug companies starts to grow. We have Viking Therapeutics has been high on my list because they're trying to come out with a pill form. They're an American company, right? So even if the tariffs do get slapped on and it hurts an Eli Lilly or a Novo Nordisk, we can certainly look at Viking Therapeutics, for example, but I like Novo Nordisk still here. It's gotten beaten up. I think it looks good. But again, let's talk about domino effect. So what happens to this new thin economy? They get skincare. They do supplements. They buy makeup. Ulta's stock has been doing well. Elf went up. It's sort of stabilizing, but that's been doing well. Then you take it on beyond that, like New Skin, which basically has emerged from the dead all of a sudden. And then you go, okay, so athletics. So Planet Fitness has done very well as people are starting to join gyms. Even Nike's been doing better, and it goes on and on. Just watch a commercial or talk to one of your friends, Ash, and say, hey, now that you're thinner, if it's a friend that you can talk to like this, how has it changed your life? What are you buying? What do you want to buy? What are you thinking of doing? Match.com just emerged from the depths of hell. So Stitch Fix, okay, this is a company that I saw a commercial for recently and it was about the fact that this woman was sitting there in her gym clothes and she was like, people think I go to the gym all the time, but I just wear gym clothes because I want people to think I go to the gym all the time. And I don't know what to buy. So I discovered Stitch Fix. And that got me thinking. If you've lost a lot of weight and you don't want to go to a store because you're still embarrassed, or you might lose more, or you might gain more, or whatever your reasons are, personal reasons, I don't want to become a psychologist on this. The idea is that why wouldn't you now buy clothes from a company like Stitch Fix that will custom to you, deliver, you can return what you don't want. So I look at the chart. 130, it was trading in 2021, 130. It went down to like 3. And now today, look at the stock. When I last looked at it, it was up like 5%. 427. We bought it at 399 this week, because this is a company that can emerge again from the depths of hell as the thin economy starts to burgeon. So that's that's to me is huge. That's a trend that's going to continue to grow. And again, the cheaper the drugs, the more people will use it. And it's not just Hollywood stars, like you said. Half your friends. I know a lot of people too. And they go out and buy things and they look better.
This is just absolutely fascinating to me. First of all, I love the way that you think, because it's really all about being driven by the consumer and thinking through that consumer thought process, which shockingly few people do on Wall Street, it seems. Try to understand what the actual human beings who are consuming goods and services think and do. But it is a moment in time that we've really just never quite seen anything this effective before. Obviously, it's still early trying to figure out what the side effects profile of these medications are going to be in the long term. We don't know that just simply because we don't have 25 or 30 years of data on them. But it is interesting, particularly when you look at some of the preliminary data showing declines in the rates and double-digit declines in things like cardiovascular death and very large declines in type 2 diabetes onset. I'm just flipping through right now what I can scrape together. And again, it's early. It's very early. But also, as you point out, these drugs are expensive. They're in short supply. They're not the easiest things to use. If you didn't have to inject yourself with a needle, if you could take a pill, I think people would certainly prefer to do that. You have to imagine that kind of research with the financial success that these drugs have had is certainly on the horizon, that pharma companies are looking into it, thinking about more effective delivery mechanisms, lowering side effect profiles, et cetera, et cetera. But it's so interesting to hear you, Mish, which I haven't heard other people do, think through the implications from a consumer perspective about what these changes might do in terms of consumption patterns, in terms of the way that we lead our lives. Just a fascinating
It's
topic.
consumer instinct. So let's go back to 2007 when everybody prior to 2007 had a Sony Walkman with black headphones. And then all of a sudden you started to see white headphones and an Apple product. And I remember thinking to myself, wow, what is this company, Apple? At the time, the stock was trading at $7, by the way. It was the same thing. I kept seeing more white headphones and more white headphones, more white headphones. And, before you know it, here we are. Apple was the story of the future at that point. So this is the same kind of thing. And all these companies, by the way, are now trying to adapt their products to the thin economy, right? So they're making, you go into a restaurant, oh, you can have a smoothie that has a certain supplement in it that's good for fat burning and muscle building. Just pay attention because like you just said, it's early. It's a good opportunity to really look at this stuff and get into it cheap as a longer term investment. And I'm not a long-term investor type trader, but in this case, I am. I mean, it's kind of like Rivian. We've talked about Rivian to the death, I know, but everything that could possibly hit Rivian in bad news has hit. And yet the stock is still trading above its lows, but it hasn't really started to explode. And I see more and more and more Rivians everywhere I go. I count them now. We went to Carmel a couple of weeks ago, and I started counting in Carmel, small town, I saw 7 or 8 Rivians in one day. And that doesn't sound like a lot compared to the Teslas. But to me, it's another one of those things like the white headphones,
A small and very wealthy town.
A small and very wealthy town. But I also have seen them now more. Well, Santa Fe is a wealthy town, too. But I'm starting to see them and they're coming out with a cheaper model in 2026.
Really interesting. Mish, it's always interesting when you join us. I love talking about not just the tactical chart analysis, but the longer term things. By the way, when you talk about something long term, my ears perk up because, as you say, you think of the world as a trader. So when you're looking at long term structural stories, I'm interested.
Oh, thank you, Ash. That's very nice of you to say. Thank you so much.
Well, it's been a great conversation. Let me ask you this. Any final thoughts or key takeaways that you'd like to leave our viewers and our listeners with?
Well, like I said, I wish I could come on and tell you, oh, we're definitely in stagflation or we're definitely in disinflation, which, by the way, disinflation is not scary. It's a good thing. Prices of goods come down. It's not deflation. That's different. Prices of goods come down as the economy is continuing to stabilize. So watch for the signs of that. That's the best thing I can tell you is watch the key elements of the metals, the dollar, the bonds, and even sugar. And watch the Modern Family for signs as well, because if it's they're gonna stagnate. If they're continuing to run, especially the consumer, then it's either disinflation or maybe just good old soft landing. We don't know yet, but right now I'm probably more optimistic than I've been from that standpoint in a long, long time.
Mish Schneider, a fantastic conversation and a fun conversation. Always enjoy it when you join us here on Real Vision.
Thank you so much. And thank you, everybody watching.
Chief strategist, of course, at marketgauge.com. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.